In this presentation, I want to talk about how low liquidity impacts bid-ask spread and trading cost. How low liquidity, influences the bid-ask spread or the buy-sell spread and trading cost. So in this regards, I want to consider number one, introduction to liquidity and bid-ask spread. Introduction to liquidity and bid-ask spread. So what exactly is liquidity? Liquidity is the ease with which you could buy or sell stocks without affecting the price of those stocks, without significantly, affecting the price, of the stock in question. So what is bid-ask spread? Bid-ask spread essentially is the difference between what the buyer is willing to buy the stocks and what the seller is willing to sell the stocks. And the lower, the better. All right. So in that case, normally in a trading platform, you have the bids column and you have the offer column. You understand? So generally, you take the highest amount, the highest price, in the bid column, and the highest amount in the offer column. You subtract the difference, we give you the bid-ask spread. The difference constitutes the bid-ask spread. So number two, the relationship between liquidity and bid-ask spread. The relationship between liquidity and the bid-ask spread we just discussed. So high liquidity in in a liquid market, there are many buyers and sellers, leading to a smaller bid-ask spread. So traders can easily buy and sell without causing much price fluctuation. So in a low liquid environment, in low liquidity, in a less liquid market, fewer buyers and sellers exist, leading to a wider bid-ask spread. This means that the cost to execute a trade increases since the difference between what buyers want to pay and what sellers want to receive is large. Generally, the larger the bid-ask spread, the more the transaction cost. The more the transaction cost. Number three, how low liquidity affects bid-ask spread. How low liquidity affects bid-ask spread. So in the case of wider spreads in illiquid markets, you observe a wider spread in an illiquid markets. When there's fewer participants, the market makers and liquidity providers increase the bid-ask spread to compensate for the high risk of holding an asset without a buyer or a seller. They have to devise a means of compensating for this particular circumstance. This leads to traders paying more when buying and receiving less when trading. They tend to pay more when they are buying, and they tend to receive less when they are selling. But they have to perform their duty as market makers. No matter what happens, they have to, perform their duties as which is a market making in stocks. So let's take a typical example. A stock with high liquidity might have a bid price of, let's say, $100. All right, and a ask price of, let's say, $100.10, resulting in a spread of 10 cents. So a stock with low liquidity might have a bid price of $100 and an ask price of $102, leading to a spread of $2, significantly increasing transaction cost, trading cost. Imagine The first instance was just 10 cents. The other one is $2. So in that case, you have a wider bid ask spread, and that will increase trading cost significantly. Please like this video and subscribe to this channel if you've not done that. Number 4, impact on trading cost. Impact on trading cost. So there's direct cost. Let's look at direct cost. So a wide bid-ask spread increases the cost of executing a trade because investors must pay the difference between the bid and the ask price. For example, if you buy an illiquid stock at $102, and sell it at $100, you immediately lose $2 per share, even before considering commission or fees. You can imagine that. So this concept is very, very important. Let's look at the indirect cost. In that case, you look at a market impact. Low liquidity means that large orders might have a bigger impact on the market price, leading to additional slippage. This happens when a trader order move when the traders order move the price away from the expected entry or exit points. That's what is called slippage. Then there's execution delays. In a less liquid market, orders might not be filled quickly, resulting in a longer wait times or missed opportunities for better prices. You may key in your order in the morning and it may not get executed until maybe 2 or so hours later. Instead of having your orders filled instantly, if you go to the order section, you observe something like you observe a message executing. They tell you executing. That means your order is still being executed in little batches because of illiquidity. So you need to wait until everything is fully executed. It takes patience anyway. So that's execution delays. You cannot very easily get your orders executed because of the matter of illiquidity. Number 5, factors contributing to low liquidity. Factors contributing to low liquidity. You consider small cap stocks. Companies with a small market capitalization often have lower trading volumes, leading to a higher bid-ask spread. Smaller companies have smaller shares outstanding. So there's another issue that's for newly listed companies, newly listed stocks that have been are listed on them. The market might have lower liquidity or fewer participants, because of the fact that they are newly listed in the markets. So also consider economic conditions. Market-wide events like recession or financial crisis can reduce overall liquidity, widening the bid-ask spread. Number 6, ways to minimize the impact of low liquidity. How do you minimize the impact of low liquidity? So in this case, you consider limit orders. So place limit orders to control the price at which you buy or sell rather than market order. Just simply fix a limit order. That will then take care of the issue of illiquidity. Not only that, you avoid large trades in illiquid stocks. Whenever the stock is considered illiquid, don't put in too much volume. Just buy bit by bit in smaller volumes. That will take care of the issue of illiquidity. All right. And then number 7, example of illiquid markets. So you have small cap and penny stocks. These are typical example of stocks that could be considered illiquid. And not only that, you have niche assets like bonds and foreign stocks could present difficulties because of the fact that they are illiquid, and so that will certainly affect their bid-ask spread. So that is all about how low liquidity, impacts bid ask spread.